Hi, I'm Emma Davidson, Director at Staude Capital, and I've recently taken on the role of Corporate Affairs at the Global Value Fund. On the 30th of June 2017, the Global Value Fund had its financial year-end. We will soon be releasing our annual report and accounts to the ASX. Today, I will be speaking with Portfolio Manager Miles Staude, asking him to provide us with a review of the year that has just ended and to comment on the year ahead. Good morning, Miles.
Good morning, Emma. Thanks for having me.
My pleasure. Perhaps we could start off by looking at the big picture, Miles. This last year has included some large shocks. We began the year adjusting to the fallout from the UK's surprise decision to leave the European Union. That was then followed not much later by the shock election of Donald Trump to the US presidency. Over this last financial year, the US Fed, the most important central bank for financial markets, has raised US interest rates 3 times. This is quite significant given there have only been 4 interest rate increases since the start of the global financial crisis 10 years ago. And somehow against this backdrop, the markets have recorded one of their best years. Tell us what your thoughts are on this last year, Miles.
Yes, it's been a year full of surprises. In my mind, the year itself was split into 2 very different periods. You had, the pre-Trump period and the post-Trump period. Pre-Trump, this time last year, a lot of people were calling a top for the equity market. The bull market in shares was 7 years old. There's a lot of arguments being made that valuations are quite stretched. And with a tightening cycle on the horizon for the Fed, there was potential for a significant correction. And really, share markets did nothing last year from July through to November. The one thing that I know to be true about financial markets is that they refuse to be predictable. Despite all the unknowns that Trump represents, his election gave share markets a terrific new lease of life. From his election until the end of the year, the MSCI World Index rose 15%, a very large move in what was a relatively short period of time. And what his election did was bring this new narrative to the market, the idea of a powerful reflation trade. Trump had made huge unfunded spending promises, a key part of his election campaign. And that, combined with the fact that the Republican Party was now in control of all 3 branches of the US government, meant the prospect for substantial US tax reform was now on the table. What markets have moved to price in quite quickly is the prospect of this fiscal stimulus and much needed tax reform. Both of these things are highly supportive for growth, at least in the short term.
So a great year for investors then, and we should all thank Donald Trump.
Well, yes and no. There is, of course, another side to the moves we've seen in share markets since Trump was elected. Tax cuts and spending promises provide a great sugar rush for the share market, but there are negative longer-term consequences to these sorts of policies, and those are generally seen in the bond market. So the bond markets have the job of pricing in the longer-term effects unfunded promises have on government finances. And the key word there is unfunded. One of the consequences of the current reflation thematic has been a significant move higher in interest rates globally. And on the back of that, there was a meaningful sell-off in most government bonds last year. So it was a great year for share market investors, yes, though for reasons few people could honestly say they predicted in advance. In other asset classes, it was a more mixed year.
I see. Well, since we know that GVF invests into a range of different asset classes, not just the share market, how did the fund perform against this more mixed backdrop you describe?
Look, 2017 was a really good year for the fund, and the team and I are quite proud of the result. To put our returns in the context, however, you're right, we don't just invest into the share market. Our portfolio comprises a very diversified range of global financial assets, all purchased at what we think are an exciting discount to their underlying value. That diversified portfolio means we don't get a free ride up in a year like 2017 when share markets are rallying really strongly. For context, our average share market exposure last year was just 28%. The flip side to that is this diversification provides us with important insurance against any significant correction in global share markets. And instead of trying to call what the market is going to do in any one particular asset class, the team and I aim to unlock value across a range of different asset classes. In terms of our performance, our net or our after fees investment return last year was 15%. And the biggest driver of these returns was our discount capture strategy, which generated a 15% return for the fund. We had some help from the markets, with positive market movements adding another 6% to our returns. but those gains were mostly offset by the negative impact of the rising Australian dollar over the year. The Australian dollar increased meaningfully in value last year, which negatively impacted anyone investing offshore.
Great to see it broken down like that. Sounds like a good result. Was there any special driver or feature behind these returns?
So there was one big factor that we exploited very successfully last year, and that was taking advantage of all the opportunities that came up in the weeks following Brexit, the UK's surprise vote to leave the European Union. In the month or so following this, what was a real market shock at the time, there's a lot of dislocation in financial markets and a lot of really cheap opportunities out there for us to find. Of the alpha that we generated last year, about a third would have come from taking advantage of these opportunities that we found following Brexit. Most of these investments have worked their way out of the portfolio now, so that one-off opportunity has come and gone. But the other 2/3 of the alpha that we generated came from our bread and butter business, finding discounted situations with a catalyst in place or with a catalyst that we could create, and having our elbows out, taking advantage of the trading opportunities that we find through time.
It is interesting to hear that an event like Brexit would throw up so many opportunities. In addition, good to see that 2/3 of the alpha still came from your bread and butter business. Now, I'd like to take this opportunity, Miles, to introduce some of the other members of the team. Perhaps I can get you to tell us a bit more about them.
Yeah, so there's 3 of us looking after the Global Value Fund portfolio. Unfortunately, it's not possible for all of us to travel out to Australia to meet investors. So to date, most shareholders have only met and heard from me. But we also have James Dow and Rob Fairbairn in the team, helping me manage the portfolio. The 3 of us worked together for the best part of 10 years, so we're all seasoned specialists in what we do. And since we're talking about the year in review, I asked them both to prepare a few words on investments that they worked on last year that contributed to the fund's performance.
Neuberger Berman Private Equity is a closed-end fund we know well, having successfully traded in and out of it in the past. It is a large, well-diversified private equity fund, while Neuberger Berman have a good reputation as a shareholder-friendly manager. The fund has historically performed very well. In early 2016, GVF built a significant stake when the fund was trading on a discount to net asset value of 28%. The fund had historically traded at an unusually wide discount for a well-performing private equity fund, and the main reason for this discount was that shareholders did not have the right to vote. This was due to a share structure that had been in place since the fund's IPO, which was designed to avoid adverse tax consequences for the fund's US investors. Following engagement with the board, a discount wider than many of its peers, and a number of like-minded investors on the register, the board announced that it would seek to find a solution to address the fund's discount. In February of this year, the fund appointed Jefferies as a financial advisor to the company to evaluate a number of options relating to its unusual structure. Then finally, in May, the fund awarded voting rights to all shareholders, in addition to moving the listing from a specialist segment of the London Stock Exchange to a premium segment of the stock exchange. As part of the move, the fund has also been included into the FTSE All-Share Index. As these changes improve the appeal of the fund to a broader set of investors, the fund's discount has tightened considerably. Over the holding period of investment, the fund and asset class have performed well, but the share price has performed better, with a discount having tightened significantly. We have been selling down the position, and the current discount on the fund is below 15%.
M&G High Income Investment Trust was a fixed life, split capital, closed-end fund, a style of investment vehicle that was popular some time ago. They were issued with finite lives and multiple share classes, each with different call over the assets of the company, and designed to appeal to investors with varying levels of risk appetite, much in the same way as structured debt is. They often had bond-like zero coupon preferred shares that offered a fixed return and provided leverage to the other share classes, income shares that paid a dividend and had a claim on a limited amount of capital appreciation, and finally capital shares that would own the remaining assets once the other share classes had been repaid. In this case, the fund was due to wind up in March 2017, 10 years after launching, and had 3 different share classes that could be invested into either individually or in combinations called units and packages. In total, there were 5 listed instruments. This complicated structure meant that there was a general lack of understanding of the value of each instrument and provided us with an opportunity. The capital shares no longer had any value ascribed to them, and the preference shares, that were effectively bonds providing leverage, were fairly valued, leaving the income shares that we identified as being an attractive valuation. Across our purchases of all classes, we bought shares on an average discount to asset value of greater than 8%, and allowing for the cost of liquidating the fund, exited the positions at a level approximately 0.5% below the prevailing valuations.
That was great. Thanks to Rob and James for that. It certainly helps me to have real-life examples of where the team have found investment opportunities for our shareholders. Now, Miles, finally, as we close out the financial year of 2017, tell us what we can expect for the year ahead and your outlook on that.
So we're starting the new year with a portfolio full of value that the team and I are excited about unlocking. There's a lot of underlying value in what we hold right now. As I said at the start, the one thing that I know to be true about financial markets is that they refuse to be predictable. So we don't pretend to know what markets are going to do this year. And for that reason, we continue to run with low levels of risk, especially compared to a general share market portfolio. Post this recent share market rally, we're starting 2018 in an environment very similar to the start of 2017. I'm reading a lot of the same sorts of things in the press today that I was reading this time last year. The bull market is now 8 years old. Valuations are even more stretched. Surely we're due a correction, especially if Trump can't push through the agenda he's promised, which is increasingly looking possible. So in that context, our performance is not always going to live up to the goals that we set for ourselves, but our focus on risk and risk management means we should be well placed to cope with any significant share market correction from here, while still providing shareholders with all of the upside that we see from unlocking the value in our current portfolio.
That sounds great, Miles, and we look forward to GVF's next financial year of 2018 with great interest. Thanks for the time today.
Thanks, Emma.